All right, awesome. We are underway. I'm just going to give it about 30 seconds. Hi, everyone. This is Alex from Voyage. Just having a look at the people who are jumping into our webinar today, and thank you all for attending. I'm seeing people that I've not spoken to for quite some time. So hello to Bernard and to Eklis. I've not had a chat to you for a couple of years, ever since I've sort of palmed a lot of the actual broking work off to David and Louise. So really, really, really good to see some names in here that I've not talked to for ages. I'm sort of more in the background now, more doing the business building and the systems and process building, and starting to get more and more brokers into Voyage, which is one of the aims that we've had. One of the aims that we've had for this year is to get another broker in and to continue our expansion, hopefully here in WA, but also over East as well. We had over 90 people register for this. So we got a really, really, really strong response. What we're going to do, though, is we're going to get started because a lot of those people, we've got heaps of people in. Most of those people are going to have said that they'd actually watch the webinar on replay, because 2 p.m. on a Wednesday afternoon is probably not the most ideal time in terms of work schedules and picking kids up from school, etc. I've also got, you may be able to see, I'm not sure if he's going to be visible yet. So this is the first time I've run a Teams webinar, so still getting my head around the tech and what's viewable and what's not. But I've got Jason Foote from the Property Investors on, and I'll be jumping into why he's on and what we're going to be sharing today. Jason, if you're available, can you just tell me, I just want to make sure that my screen is available. Can you see the Voyage Wealth webinar?
Hi, everyone. Hi, Alex.
Hello.
Lovely to be here.
Welcome. Just to ensure, because you're the only person who can respond to me, can you see my screen?
I can.
Excellent, excellent, excellent. All right, let's get stuck in then. All right, cool. So the purpose and agenda for today, given that I know, sort of Jason and I had a chat about this beforehand, we know that everyone is pretty time poor. So we've decided to keep the webinar to 45 minutes. With no Q&A. We're just wanting to respect everyone's time. And what we want to do, though, is give you an opportunity to reach out to us at the end and book an appointment with the Voyage team if what we're talking about is of interest to you and if you'd like to discuss it further. The primary purpose of today's webinar is to introduce Jason and the Property Investors team to our clients. We've actually already done that on a couple of occasions to a couple of clients. And Jason, we've actually talked, we've run a webinar or a meeting before that we recorded, which I actually somehow managed to delete. But we've been working with Jason and his team across a number of clients and deals over the past year. And every time that I speak to Jason and every time I hear Jason speak, I feel as though I need to go and check my borrowing capacity and start buying property, because the strategies that he shares and the insight that he has on the property market and where the property market is going is it's pretty inspiring, and it inspires it inspires me to go out and check stuff and do stuff, and so I'm hoping by the end of today we can sort of get you into that position as well. A second objective is to make you aware of some of the pitfalls of property investing and address the fears that some people have and the fears that are sort of reflected back to us on occasion when looking at starting or continuing their property journey, and sort of show you a bit of a pathway that we've developed into safe and strategic investing. So let's start with that second point first. And I'm going to talk for about 15 minutes, and then I'm going to pass over to Jason. It's really important that I start here, though, which is talking about the result that we want for all of our Voyage clients, both on the financial planning side and on the mortgage broking side, that we've, that Matt, my financial planning partner, and I developed years ago, which is that we want our clients, no matter whether you're a financial planning client or a mortgage broking client, we want you to be on a really clear pathway to wealth through asset classes that you're comfortable with. And typically, no matter if you're on both sides or no matter which side, this typically looks like a quality property portfolio that grows in value and income over time, shares and superannuation that grow in line with or exceed the market. Typically, we do a lot with investment bonds as well that provide protection from tax and possible other creditor action. And we want investment in these assets to be driven by focusing on your careers and family, and for a lot of this sort of wealth building and investing stuff to happen a little bit in the background. So but also for that investing, like all of that activity and that growth being driven by your an allocated excess of your income and investing that consistently over time across various asset sources. And this is something that I talk about. This is probably my own parlance more so than the team's parlance. But whenever I'm trying to solve a problem, or get to a particular outcome, I'm thinking in terms of investing for a solvable problem, like trying to figure out what the problem is that we're actually trying to solve, and then how we get there. And I'll be explaining that a little bit as we go through. So one of the things that is reflected back to us when we're talking to clients is, in our experience, we found that many people who want to start investing or continue growing in their property journey have thoughts somewhere along the lines of, I'd really like to start investing or continue, but we're not sure where to start. We're not sure how much we can afford. We're not sure what strategy we should be employing. We're afraid to purchase a property that declines in value. We think that maybe now's not the right time. We're not sure if it's the right financial decision for us. And what we find is that these fears and concerns are definitely 100% valid, and you should absolutely be thinking through these things, but they come as a function of understanding that there is risk and reward in property investing, just like there is with any investing, but potentially not fully understanding where those risks lie and actually how to mitigate them. And this leads to, or it pretty much leads to two pathways. So number one is not proceeding with anything at all, which leads to lost opportunity and potentially getting left behind. And number two is the second pathway is proceeding, but then actually failing to mitigate those risks, leading to all sorts of problems down the line. Some of the problems that we see are typically making poor property and suburb selections, leading to issues with the actual property itself, or struggling to rent it out, or finding low or sort of anemic growth. Employing poor financial strategy, so typically overextending, putting in place inappropriate buffers, or putting in place incorrect collateral. Also pretty commonly is incorrect or poor tax and asset protection. And this all leads to properties taking people further away from what they're actually trying to achieve, and on occasion putting them in a situation worse off than where they would have been had they actually done nothing at all. So that's almost like the purpose of today's webinar, and for getting Jason on to explain, the risks, but then also the opportunities with property investing. So I guess I'm representing, talking more about the risks, and then Jason more about the opportunity, which is, to be fair, probably the much more exciting part. So the way that we absolve this, or we mitigate this, is with good financial and property strategy. So we're looking to mitigate risk. We're looking to provide a clear pathway. And most importantly, we're wanting our clients to be able to sleep at night, knowing that no matter what happens in the economy, no matter what happens personally, we've put a lot of work in up front to ensure that you guys can sleep at night. So putting in place good financial and good property strategy. And I've sort of represented this. I was thinking through this today when I was putting this slide deck together, and the way that I visualize this is almost like a triangle, with the base of that triangle being mitigating personal risk with asset, finance, protection, and proper tax strategy. And this looks like making sure that we've assessed and stress tested our numbers and figures, and we know that we can hold a property across time, even in the face of unforeseen circumstances. If we set that as a base, we could then start to have a look at the actual property strategy and property selection as well. So, mitigating any property selection risk with good strategy and good data. This looks like, setting up a great property team, which is obviously why we've got property investors here. That is, people who are actually able to put us in suburbs and in properties that are primed to outperform. And that means the very top of the triangle, the risk that a lot of people focus on, which is like, what happens if we're purchasing at the wrong time? What happens if the markets drop? What happens if interest rates rise? That sort of economic risk. We can actually not worry too much about that type of risk, because, we're not too concerned about time in the market or what happens with interest rates. We can continue to invest in confidence, and we can, most importantly, sleep at night, because we've got a really good financial and a really good property strategy in place, and we've done that homework before we've ever put pen to paper and actually purchased a property. So all this to say, there's a lot to get right. We find that many people don't, and I think you can see the point that I put at the bottom there. I think that many in Australia, many are lucky that the Australian property market, especially in the last couple of years, and Jason can talk to this as well, it generally goes up, and nothing bad happens to most people. But you talk to any accountant, financial planner, mortgage broker, advisor, and you find there are a lot of people who have done something wrong, or the property market's dipped. And we've certainly seen, in the last couple of years, everything's done well, but before that, and it will happen again, there'll be an economic shock, there'll be something that happens, there'll be economic conditions change, and then all of a sudden we're finding that unless we've got really good property strategy and financial strategy in place, people find themselves in strife. So property investment really actually requires a team of professionals. It requires brokers looking at borrowing capacity and lending policy and bank products and financial stress testing. It requires accountants looking at legal structures and minimizing taxation, which is a massive part of the property investment journey by design from the government, which I think is something that Jason is also going to talk to today. It requires the input of planners looking at wills and income protection insurance and life insurance, and also then looking at sort of broader financial implications and strategies. For example, potentially looking at property in SMSF, which is something that brokers can't advise on, and probably most accountants, unless they know your full financial plan and your full financial desired outcomes, unless they know that, really should be something that planners are looking at. And then obviously the property strategists as well, seeing trends in data, finding suburbs that are outperforming, selecting the correct property within that sort of suburb data set, and then negotiating on that property as well. So the approach that we're sort of the approach that we're developing at Voyage, given that we've got plenty of experience on the financial planning side, on the broking side, we're looking at developing this sort of circular, ongoing financial planning inspired approach, which is where we're really looking at what we're trying to achieve, figuring out what we can do, which is effectively placing parameters around, there's no point in saying this is what we want to do unless we actually understand this is what we can do first. So understanding what we can do from that box, then figuring out what we should do, executing that, and then reviewing that, and then going back to the top and effectively trying to make it this, as I said, instead of just like buying a property and then that's it, is developing this ongoing strategy where we're constantly in this cycle of what are we trying to achieve? What are the actions that we need to take to get there? What can we do? What actions do we need to take? Actually executing that, and then going back to the top and figuring out how much closer are we to the goal and what else do we need to do. I'm going to quickly skip through this because I just want to make sure that we're not going to exceed our 45 minutes. But if we're looking at sort of the points within those 5 goals, what are we trying to achieve? Sort of looking at where we are now, what we're trying to achieve, what sort of timeline we're on. So being able to hold property over the long term is ideal, but understanding what that timeline is really, really important. How much risk we're willing to take on, and what resources we have both now and anticipated in the future to achieve what we want. Determining what we can do is really where the financial strategy comes in, and that's where we want to lay down that financial strategy first. So what type of equity and cash position are we in? What can we borrow? What can we comfortably hold for the long term in the face of a market downturn, assuming increased interest rates, assuming vacancies and drop in income, etc. Thirdly is then from within that box, and once we've developed those parameters, figuring out or determining what we should do. And this is where we look at bringing in, accountants, property investors, our financial planning team, if required, coordinating with all those other professionals, having them understand the strategy that we've co-developed, and getting them to contribute their parts. So looking at accountants for tax and entity structuring, property investment advisors, etc. And goal 4 is actually, of course, then executing that. So getting valuations, pre-approvals, legal structures, finding the property. If we're looking at a building project, then signing building contracts, all the other bits and pieces we need to do to execute. And then finally, sort of the last part in that circular process is an ongoing review as well. So understanding that we need to put in depreciation schedules to get the maximum out of our property. Depreciation schedules, property management, valuations, looking at rates and finance reviews, putting insurance in place. So as I said, there's a lot to take in. A lot of people, I've had plenty of clients come to me who've just gone out and purchased a property without any of this, and they've done okay. But it's as much about maximizing our potential, ensuring that we've got all the bits and pieces in place, understanding a lot of us, we don't know what we don't know, and so we need to ensure that we've got the property team around us to remind us, advise us, help us with the strategy, and ensure that we're not making the mistakes, but then of course that we're achieving the maximum potential as well. So I think with that that's my keynote presentation. I'm going to stop sharing. That's where I want to bring Jason in. And I'd like, Jason, if you could
Sure.
speak to that if you wish, or if there's any points that you think that could add to that.
Why don't we do this? So first of all, I thought I'd give you a bit of an introduction on myself and property investors, and so you know sort of that we're pretty qualified to be having this conversation. Then what I want to do is actually touch on some of those points that Alex has actually already brought up, and talk more strategically, right? Because one of the things Alex said is about maximizing, and I'm all about maximizing. So let's walk through that, and then risk is a very big part of it as well, which is all strategic. So I'm director of strategy, and so therefore that's all I think about, right? Is strategically how to structure and make money and get cash flow and minimize risk. That's really what it's all about for me. So I started investing about 30 odd years ago. I'd met my first mentor back then. So he was 36 years old. He had 44 properties. I was like, right, I need to pick your brain. My accountant had actually said it'd be a good idea, Jason, if you bought 1 or 2 properties, but couldn't give me any guidance, right? He was just all about getting the tax deductions because I had a big tax bill. And so I literally talked this guy into mentoring me, and I followed him around, and he had a particular formula that he used in order to find maximizing property assets. And that's still what we use today. And I'm going to touch on this with you guys as well. And in my first 12 months, I bought 10 properties. Right. I was like, wow, like I've made more money this year than what I could have possibly done in that business I was running. And so I was all in, and I was just following him around, and he was teaching me, but he was using me as collective bargaining. Right. So we'd be talking to a builder. The builder's doing 12 townhouses, and between 3 of us, there was another guy who was a doctor, we'd buy 6 of them, 2 each, and we get a better deal. And so that's how I started. So I moved into this industry a year and a half later, and built a reasonable business with my ex-wife. And then that didn't work out in terms of the marriage, right? So I then got asked to do the speaking circuit for 4.5 years. And when I was doing those events, and they were pretty big events, I was always presenting what I'm going to present to you guys now, which is really strategy and to maximize those 3 points. So property investors we've had going since 2012. We've got 2,600 investors that have so far invested in just shy of 6,000 properties. So we're not small. All of those properties are growing. They're all cash flow positive. Okay, so yeah, and the fact that there's 6,000 properties, 2,600 investors, that should tell you that we've obviously got happy clients that are making money, that are coming back and doing it again and again. Okay, so that speaks volumes, and that's the reason why I like to tell people those numbers, because we're particularly proud of that. So in terms of the approach and the way in which we deal with a client, is that we've got a 6-step process. So we hold a real estate agent license in every state. We make our money out of the transaction. So every single property that transacts in Australia, there's a real estate agent making a commission, whether it's the 2% or 2.2, whatever it is that they charge. If our client makes that transaction, we get paid the commission instead of Ray White. Okay, so it doesn't cost any money to deal with us. And the reason I'm telling you that is that you will never send an invoice to a client, right? Ever. And as a result, that means that we can actually have full flexibility to go anywhere in the country based on our criteria. And our criteria is very simple. We want to maximize capital growth, we want to maximize cash flow, and we want to minimize risk. It's really that simple. Now, the execution of that is not as simple, but basically that's the process. Now, the process we'll go through with the client. We're not a buyer's agent, so we're not charging the client. We're not taking a brief from the client. We're saying, right, do you want to achieve those 3 things? Great. Well, then we have a 6-step process that we go through. All right. And it's much more like what a financial planner would do than what a real estate agent would do, right? As an example. So, and we built our whole business on affiliate partners, right? Like we do with Voyage. Right, so that's all of our affiliate partners. They refer clients to us, and that's obviously how we build a business, because they know we're going to look after their client. Now, once we get through the process of speaking to a client and presenting a strategy, that's what I want to touch on with you guys today. All right, so I'm going to share my screen, and let's have a look at first of all the approach. So rule number 1 is that you don't play the prediction game. That's fraught with all sorts of risk. Yeah, it is literally crystal ball stuff. And we've all got an opinion what we think is going to happen to interest rates in the market. All of us, I have my whole career, right? But I've very rarely got it right. I mean, I've always known what the next stage of the cycle is. But here's an example. I didn't know after the GFC, after monetary policy kicked in and all interest rates came down and first home buyer incentives came in, that we're going to have super low interest rates for what, 11 or 12 years. I knew it was going to be a low part of the cycle, but not for 11 years. And then end in a pandemic. I mean, who predicted that? No one, right? So prediction is fraught with all sorts of risk, and that is not what we do. We want to basically play the long game, and this is one of the things that Alex touched on as well. So it's what I call the get rich slow. Okay, yep. We're playing all of the cycles of the economy in the market and winning in each stage of the cycle. And this is what I was taught 30 years ago, and I've just watched it played out ever since. We want to invest in properties where someone always needs to live, no matter what the economy, what the interest rates, what the market. And so that means that we're not investing in luxury. It means we're not investing in lifestyle like holiday stock, all right? Because it's just much more volatile. And I'll give you an example. I mean, during COVID, one of my properties, I mean, I wasn't on the front foot. I should have been, but my tenants were actually in the hospitality business, right? So obviously they weren't doing too well during COVID, and I ended up kicking them out. Straight in was someone in e-commerce, right? Immediately, so you might not have the same tenant, but it's always there's a demand, right, for someone to live there, and that's what's really important. So cash flow is really important because most people have some kind of mortgage debt or living expenses are going up, but also most risk is associated with cash flow. I've never met anyone in my whole career that's regretted investing in property, right, and holding on to it. I've met plenty of people that have regretted having to let go. Why did you let go? Well, I let go because I couldn't afford it anymore. It was the cash flow or divorce. Now, I don't have an answer for divorce. I've been divorced twice. I mean, I think I've met my future ex-third wife, but I'm not sure. So basically, in terms of how do we achieve this maximize capital growth, maximize cash flow, minimize risk? Well, this is what I was taught 30 years ago, and it's never failed. And I'll give you a couple of examples. Number one, the area that we go to, we need a minimum rental yield in the area of 4%. Okay, so that's our baseline. Now, the actual property you invest in might be 5.1, but the actual area must be getting at least 4. Now, I'll come back to number two. Number three is the area must be heavily gentrifying. So in our world, what that means is that there's a load of young working people coming to the area, which is causing a net population growth, but they're young working people. And so as a result, there's got to be construction that meets the demand. So the demand is high, supply is low, and there's a pre-existing yield of 4%. So obviously all the property is going to be new because they're building it to try and catch up to the demand. But therein lies a whole bunch of other opportunities as well. And the other reason why we want it to be brand new is because we want the tax credits. We want the depreciation, which is what Alex touched on before as well. And so in terms of that, 95% of my clients, and my prediction is this is 98% of the whole population, they must get the tax credits or they're not going to be able to afford the cash flow. So when people say, oh, I really want to buy an existing established property, and I look at their numbers and I'm like, well, you can't afford it. Like, what do you mean? It's like, well, I can afford $650,000, Jason. I can go and buy a house for 600. Yes, but because you're not getting any tax credits and you're getting a rental on it of 4.1% or whatever it is, if you weigh it all up, you're going to have to tip in an extra $250 a week. Can you afford that? Oh, no, not really. Not with 2 kids and paying this and paying that, paying everything else. But if it was brand new, same price, same rent, and you're getting the tax credits, you're actually cash flow positive. Instead of being $250 negative, you could be $40 cash flow positive. So most of my clients are 95% of them are negatively geared, but ultimately they're positively cash flowed. So negative gearing means that the income, the rent, is less than the total costs. So let's say the rent's $500 a week, the total cost is $600 a week, you're negatively geared 100. And that $5,200 a year you can claim as a tax deduction off your income and then claim a tax credit. Okay, so you can definitely do that even if it's an established property. However, it's not enough. When you can claim all the depreciation of the building, the fixtures and fittings and the oven and the carpets and everything else as well, then in that example, it might, depending on your marginal tax rate, but it might push you into like $130 to $140 tax credit, which now you're $30 or $40 cash flow positive instead of being negative. So you're negatively geared, positively cash flowed. Now, a lot of people say, oh, but isn't it better to positively gear? It's like, well, the only way that I know how to positively gear is that interest rates are super low, like they're less than 2%, right? And that's obviously not our current market. And also it's not sustainable. Or secondly, you put a whole lot of cash in or a whole lot of equity in and your borrowings are actually lower, right? So you've got much less costs, so therefore puts you in a positive gearing scenario. Or you're a developer and you've built it and this is like you've got a surplus couple of properties from your development and you hang on to them and the cost of what they cost you is much less, so your leverage is lower. I don't
Yep.
know of any other way to actually positively gear in the residential scenario. So therefore, my top 5% of clients that are earning more than $500,000 a year, they've also got loads of cash and they've got a lot of income. And quite often I'll structure them on a positive gearing scenario and we load the ownership into their spouse's name and the spouse will still meet below the tax-free threshold, right? But they've got
Yep.
cash. They're like, Jason, I've got cash. If I leave it in the bank, I'm losing money because I can't earn enough interest and pay tax on it to outperform the actual inflation.
Yeah.
Okay. So
And that's where
coming
this
to
concept of like,
yeah, so basically we invest when we can afford to. We enter the market when we can afford to. We don't play this prediction game. It is fraught with all sorts of risk. You invest when the bank says or your broker says, this is what you can afford, that, and they're more conservative than anybody. Banks are more conservative than anyone. If they say that you can invest, that's when I invest. And so it depends on where you are in the cycle as to what the benefits are going to be. So if you're following this particular criteria, and well, here's a very good example, right? So when the market was really booming really hard and the interest rates really low, it's very frustrating for someone like me because everyone is an expert. It's
yeah,
pretty easy to
everyone's
make
winning.
money out of property when the property's booming and the cost of money's low, all right?
Yeah,
It's very
everyone's a hero.
frustrating. Exactly. So, but I'd look at what they're doing and I'd say, yeah, but like you wait till interest rates go up and you'll realize what you just done because you won't be able to afford the cash flow on what you just bought. And so some people listened to me, some people didn't. But what definitely happened is that when interest rates started to go up, right? So I didn't know when they were going to go up. I didn't know they were going to last for 12 years. But when they eventually did start going up, then what happens is that I've had the busiest 3.5 years of my life, right? Because people are like, oh, you were right, Jason. You know, when interest rates went up, we couldn't afford it now and we should have listened to, or lucky we did listen to you. And can we get another one? Or can you talk to my brother? So that's what happens when interest rates start going up, because when you follow this model, when interest rates go up, the rents go up. So therefore, when you're in a cycle of the interest rates increasing, your rents are actually going up. Now, what we've come from is basically we had very, very low interest rates and we had a booming market. And then we had COVID hit and the government went stupid with spending. They printed money, created an enormous amount of inflation. So that's a bugbear of mine. Let's not go there. But the reality is that we not only get penalized with inflation, we get penalized a second time with interest rates as well to then curb our spending to bring down inflation. And so what happens now is that we then go on the cycle of increased interest rates. Now, what happens, the reason why rents go up is that less people buy. So if less people are buying, more people are renting. It's really simple mathematics. And so if there's more demand on rents, the rents actually go up. Now, in addition to that, and this is post-COVID, they open up the international borders and we have, depending on what data you read, it's over a million people in 3 years. I mean, it's stupid numbers in terms of, and these are rental demand, right? These aren't 80-year-old people. These are people that are coming in, they're working, they're young, and they're predominantly renters. And so we've got more people renting because interest rates went up and they're not buying. We've got more people renting because we've got more people. And then we've got to slow down the supply. So we have this perfect storm where interest rates spike. Where interest rates go up and the rents spike, right?
Yeah.
And so the problem is that we've now got tent cities everywhere, right? There's homelessness as a result of this. It's like, it's diabolical. But my clients love me, right? I've all of a sudden, like, I'm a god. It's like, oh my God, we didn't think that we're going to get this much rent, right? Like, it's actually helping pay off my house. And so the whole notion of I'm going to wait for this to happen, I'm going to wait for that to happen, it's a fool's game, right? You make sure that you have a strategy that no matter where you are on the cycle, I don't need to know when that part of the cycle happens. I'll predict it, but it doesn't matter if I get it wrong or right. It doesn't matter because I'm playing the long game. And so what happens then is when interest rates start to come down, then you have more people buying, and guess what happens to prices, right? They actually start to increase. Now, just on this point is that We've also we're now in this starting to gradually the interest rates are coming down and there's confidence starting to come back in the market. And obviously, and that's what we'll start to see the prices. But even so, the last 3.5 years, I've had lots of clients make money in capital growth as well as cash flow as well. And I'm going to show you that in a second. But the reality is that we've now got this Labor government that control everything. And their answer to everything is to raise taxes or to tax reform. And I've never in my whole career predicted what I'm about to tell you. And that is that I think that they're going to mess around with negative gearing tax laws. I reckon they're gonna have some kind of say in it. They'll probably do something similar to CGT. Now, if they do, then they have to it has to be grandfathered, right? So in
Yeah.
other words, you can't just go irrespective of every single property that's ever been invested in history, and we'll change the tax laws and all of it. That would end up
Yeah.
in a
It can't
full property
retrospectively apply it.
collapse. And we've got total gearing, I think, across the board of an average of about 64%, right? So 64% loan to value ratios across Australia. So you've got a banking collapse now. And even if you had a moronic prime minister that implemented it, you'll have the banks block it, right?
Yeah.
Like, so I can't see them doing it retrospective. It will be from that date onwards. And they've got a lot of work to do. So if they're going to do it, it's going to be 2 years, 3 years away. And so since election day, we've been flooded with calls from our clients saying, "Can we get another one? Can we get another one? Can we get another one?" Because they're wanting to get in before that deadline, right? So they can still get those tax benefits. And we're watching interest rates start to turn. So we're literally about to go through another phase. So basically, with respect to negative gearing, and just to give you a very quick history lesson on this, negative gearing was actually introduced in the early 1900s. Now, think about the early 1900s. There were 12.1 taxpayers for every retiree. So there was a shitload of money, right? There was a lot of money to pay pensions. There was no shortage of money. There was no borrowing money to pay people pensions back then. And so what was considered security for someone is you work the same company for 30 to 40 years, right? You get your fake gold watch at the end, and you live on you pay off the house and you live on the pension, right? Because there's plenty of money from the government to support the pension. So why did they then introduce negative gearing? Well, the government worked out that it's a heck of a lot cheaper to pay tax credits to an investor to build properties than it is for them to build it themselves. Much cheaper. To government housing, therefore, their budget for government housing went way down, and it all maintains a good equilibrium in terms of rental affordability. More supply, rents come down, right? So therefore, they're giving tax incentives to do that. Now, everything went great until 1985. So June 1985, Paul Keating, Bob Hawke, Labor government. Now, I don't care as Labor, Liberal, they're all lies as far as I'm concerned, but Labor, these are the policies that they have, right? So they convinced the Australian public that negative gearing supports wealthy people. And it's bullshit. It's not true. Negative gearing is trying to get all those tax credits to create some cash flow for people who don't have a lot of cash flow, right? That means that they're usually middle income earners, policemen, school teachers, right? Truck drivers. I mean, like, these are the types of people that will negatively gear. And so, but they convince the Australian people, look how much billions we're paying in tax credits to negative gearers that are wealthy people. We need to stop it. So in June 1985, they axed negative gearing. Now, they had to reintroduce it again in 1987, 2 years before they fell on their sword and did a full 180. Why? Because rent spiked. What a disastrous decision under a Labor government. So they had to fall on their sword. So basically, will it happen? I think there's a really good chance the Labor government's going to mess around with it because they're just that dumb. But the reality is that it's creating this window of opportunity where loads of people are getting on, and also we've got interest rates doing what they're doing. Now, in addition to that, whenever there's some kind of crash in the economy, and the biggest crashes usually caused by stock market crashes, or stock market crashes are the result of, right, when the economic so Black Monday, 1989, or when was that? 1989, I think it was. The 90s recession, financial crisis, the dot-com bubble bursting. I mean, that's when I was investing in properties. I was freaking out because I was so naive to all of this, and my mentor was like, Jace, chill out, man, right? Whenever there's a crash, so if you've got a stock market crash, that means that people are pulling lots of money out to put it somewhere else, right? And that's why the market crashes, because all the value of the market's been pulled. And so if there's a run like that and people are freaking out, there's only three places that the money can go. It goes into cash, so banks and funds, right? So mortgage funds and that sort of stuff. Or it goes into alternatives. So there's precious metals and there's all types of alternative investments and real estate. And so real estate always grows after a crash. So if we also have a crash or, had those jitters amongst the, after Trump brought in some tariffs and all that sort of stuff, and those jitters in the market, all that sort of stuff, it affects the top 8% of wealthy people, because that's where the majority of the wealth in the stock market is actually those wealthy people. It's not mums and dads. It's not people that represent 80, 90% of the population. That they will be exposed through their super funds, but they're not share traders, right? That's not basically how it works. But when the money comes out, you will see property growth. So the stock market crash, it'll be a Hail Mary. So one of the things I just want to just touch on very briefly is that 95% of our clients, they need the tax credits, but they also need the bank. And so when I'm talking to them and they say, oh, look, what do you think of gold, Jace? It's a great investment. It's a really good investment. What do you think of blue chip share? And I've had thousands of people say this to me from when I'm on stage talking to, to loads of people, is they'll say, I've got a share portfolio that's growing at 9.1% per annum. Average in property is 7.2. My share portfolio is better, right? And my answer is, I'm sure that you do. And I'm sure it's blue chip. I'm sure it's safe. Okay. No argument from me. So let's say that you got 100K. You got 100K out of your super, you got some cash. Maybe you pulled out some equity, but let's call it cash or super just to make it easier to understand. Now, property is 7.2%, so it's 5 to 10. Gold's 5 to 10, it's 7.8. Right? So everything's in that realm of 5 to 10. I'm not talking about the latest AI stock that goes to IPO and that potentially doubles your money in a week, because you can also lose it in a week, right? And same with crypto. I'm not talking about that stuff. I'm talking about sustainable long stuff over a long period of time. It's 5 to 10%, and that's the risk profile. So I'll put my 100K into, say, gold. It grows at 5% 1 year. I've made $5,000. My ROI, my return on investment in 1 year is 5%. Okay, so that's pretty easy maths. Now, could I buy a property for 100 grand? Well, you could. I mean, I've got a client who lives in the wheat belt in WA. His property's valued at 100K, but it definitely does not meet the three criteria. Okay. So to buy a property with three criteria, now you're probably looking at minimum 650, maybe 550 to 650 minimum. So our property, the ranges with this formula is going to be 550 to 800 max. So if I've got a client that can afford $5 million, I'm building a portfolio across multiple states. Okay, I'm not going a higher price point thinking I'm just going to try and make more money out of the client. So basically, in this situation, what I can do, and I've just got round numbers here. Let's say I bought a $500,000 property that met three criteria, and I put in the 100K for deposit and stamp duty, and the bank funds the rest. All right, so that's where Voyage can come in and say, right, we can get you the loan, we can do all of that, and based on this model, it'll be cash flow positive. So it's not costing me anything. And
actually interesting that, sorry, I was just going to say, it's actually interesting that you've included this slide. I've not seen this presentation before, but I cut a slide out of this, the part that I talked about, just showing the difference between leveraging to 90%, like basically the difference between return on capital and return on asset, and how the return on capital doubles if we're leveraging to 90% versus if we're leveraging to 95% on a property. And I know, like, to some people listening to this, that sentence is probably not going to make a huge amount of sense, but basically just being able to borrow a little bit more, which doctors are able to do for investment property, by going to 90 to 95%. It only sounds like a little bit, like 5%, but it actually doubles your return on capital over time.
And you get more to tax credit as well. You get more to claim on tax deduction, right? So you would never do this on your mortgage. That's a different story, right? You want to get rid of that debt. You want debt across income producing asset growing assets, right? So in this example, if I buy this property at 500 grand and grows at 5%, well, it's actually made 25 grand, because it's the whole asset that's grown at 5%. But I've only still put in my same 100 and it's cash flow positive. So my actual ROI and the money that I tipped in is 25% without taking more risk. And that's the difference. And that's why 95% of my clients, I stare them in the eye and I say, you don't actually have a choice about whether you invest in gold or shares or everything else. You can't afford it. You've got a $500,000 mortgage. You're earning X, right? Where's this money coming? You've got two kids. Like, where is this money coming from that you're going to tip into gold? Like, you don't have the cash. You need to be able to go to the bank, and the bank won't loan you money for gold because it's got no income. Like, even though it's a good investment, it's got no income. So the bank is only going to give you money for property, and they're going to give you more money for residential. You can't even afford commercial, right? You have to invest in residential because the numbers, it's the only way the numbers work. And so this is obviously what I wrapped my head around, 30 odd years ago. And I was following my mentor around, and we're literally buying new stuff. They're gentrifying areas, they were growing areas. And basically I was putting deposits down, right? Because a lot of the stuff's actually in construction, which I was completely comfortable with. Now, on the second property I ever bought, it was a townhouse. I put 10% down, signed a contract. I was told it'll take about 12 months to build, right? We get to 9 months. And the builder says, or the developer says, oh, look, we've run into some problems. It's probably going to take an extra 3 to 6 months. Now, me being young, naive, completely green, I cracked it, right? I had a hissy fit. Word got back to my mentor. My mentor called me and he goes, Jace, are you going to live in this property? I said, no, because think about it. If you're going to live there and you're told it's going to be an extra 6 months, you potentially could crack it because you've got to make living arrangements. But I was like, no, I'm doing this investment plan with you. And he said, well, you probably should shut up because you're embarrassing yourself. And I said, what do you mean? He said, well, let's have a think about this for a minute. If it takes an extra 6 months, are you taking more risk? Yeah. He goes, are you? And I said, oh, no, it's the developer. And he goes, yeah, it's the developer and his bank. They're the ones taking more risk. Where's your deposit sitting? Solicitor's trust. I've got a trust receipt. Did the price on your contract change? No. Is the market shifting? Yes. So you've got another 18 months in the market without actually having to settle on it. It's got to be worth more by the time you settle. I'm like, oh. And he goes, what's happening in the rental market? Yeah, that's growing as well. Oh, well, he can take a whole nother year for all I care. And he goes, yeah. Like I said, oh, I did make a fool of myself. So that's when I first understood about this whole controlling concept without ownership. So let's say this same property took 12 months to build. It's still exposed to the market growing at 5%. So it's still making 25 grand, but I've only put 50 in. I've got my other 50 somewhere else. And so on that 50, I've made 25 grand. I've actually made a 50% ROI on the 50 grand. So most of our clients, phase one is they're controlling, but they've got to go into phase two, which is leverage, right? But by the time they get into leverage, and here's a good example, COVID hits. Now, we've never been through a pandemic. No one has. And everyone's freaking out, right? So we're like, well, hang on a minute. Let's just follow the guiding light. Right, 1, 2, and 3. Where in Australia are we getting the maximised gentrification? Southeast Queensland. All right, well, that's where we go. Because there's no international migration. There's no gentrification anywhere except for local migrants going to Southeast Queensland.
Yeah.
So we start looking at Redland Bay house and lands for 580. We start finding $390,000 3-bedroom townhouses in Pimpama. We're getting 2-bedroom apartments in Maroochydore. Everything doubles in 3 years. And everyone says, oh, how did you predict that? Well, we didn't predict it. We just followed the formula. Now, that's an extreme example. But the point is that all my clients that put a 10% deposit down on that 2-bedroom apartment, right, in Maroochydore, at $430,000, when it came to settle, is worth $690. So they can actually get a val on $690 and borrow against the $690, right? And so they're massive. The controlling strategy, that's an extreme example, right? It's not a promise on everything, but you get the point. And so when we ultimately present a property to a client, what differentiates us with everyone is our research and the due diligence. And so we've now got it in a very simple format for our clients to understand. So we've broken the due diligence and the explanation of the area. Well, why are we even here? Why are we in this particular spot? What's going on here that's so special? So we measure the socioeconomic. What do we want? We want young working people, either young professionals, young couples, young families. And so they're going to be your 30 to 39-year-olds or 30 to 45-year-olds at tops, but they're all working. And then we'll score that category out of 100. The category of a house, a townhouse, or an apartment, which one? And by the way, I'm not talking about apartment towers in the city. That's garbage. That's oversupply. Yep. That doesn't fit the formula. It's boutique. But either way, we measure the category of what asset class it is. We measure the infrastructure, the demand, the yield. Remember, we want the yield minimum 4%. And so an example of this, so here's an area, Malvern in Melbourne, that I was presenting to clients in February 2023. right? So the socioeconomic, we scored at 96, really, really high because, you know, they're obviously higher income earners, 20 to 35-year-olds. Perfect. That's what we're looking for. The category, what's super high for an apartment. So apartment median house price was 738 grand. Median house price was actually about 3.5 mil. And that's what you want when you invest in an apartment. You want a really big discrepancy between the median apartment and median house price. So that scored an 89. Infrastructure is really high, existing train, trams, shopping centre, personal training studios, everything that young professionals want, because that's our market with the apartment. Demand is really high at 84. Yield is 4.6. That scored an 82. And so we gave it a weighted score of 88, right, for that area. Now, everything on our list has an 80 to 90 score, just so that you know. So this is at the high end of the spectrum. I'm presenting an apartment to a client in February 2023, and 670 grand was the purchase price for a 2-bed, 2-bath, single lock-up car, single car space. Rents at back then was 650 a week. Now this is about to settle. Vals are coming in at 850. Rents are coming in at 800 plus a week, right?
Yeah, that's stellar.
And people have only got a $67,000 deposit down. So they've made
which is
just shy of 200 grand on 67 grand. That they didn't even fund the 67 grand. They took it out of their mortgage. So it's the interest cost on the 67 grand.
Yeah.
So you reckon I've got happy clients, right? And this is during the time when it's supposed to be high interest rates and the market's supposed to flatten out. Okay, so that's the thing is that when people say, oh, can you buy something in Newcastle? No, right? Like that, you need a buyer's agent. Go and give him a brief and pay him 20 grand, right? That's not what we do. Do you want to maximize your capital growth, maximize cash flow, minimize risk? Okay, well then we'll follow the formula, right? And when we invest in properties that do this, then we eliminate most of the risks, which I haven't got time to go through now. But the point is that to be successful at this, you want to make sure that you've got a strategy to mitigate all the risks. And that's what we educate our clients on. So the moment interest rates go up, 2,600 clients, not one phone call. Someone loses their job, no phone calls.
Yeah,
right. They've got to kick their tenant out. No, everyone's educated. Everyone's got a strategy in place. And because of the type of criteria, the property they've invested in, they're not exposed, right, to the risk that way. Yeah. So essentially, we've got a 6-step process. And obviously, if it's deemed when you meet with, Voyage that basically that's the path that you want to go through, then, you then are introduced to our path, right, as an affiliate.
Yeah, perfect. Well, I think we've now hit our 45 minutes. So I think there's
I was trying to squeeze out as much as I could.
I know. That's the thing. So even from what you were saying, I was like, oh, I actually had included slides on leverage, but I cut it out because to explain leverage properly, there's a whole education piece that needs to go in behind that. So I might actually, this has inspired me to start doing some more videos and pushing them out. But I think what Jason is saying is that there's always opportunity in the market. There's definitely opportunity now. And I think that our job for our clients and potential clients at Voyage is to help with that education piece, help with that risk minimization. Same as your team, Jason, with the risk minimization, ensuring that we're selecting the right property, we're putting the right strategy in place in order to get to where we want to get to, which is pretty let's say restful nights and not having to stress about property, not having to worry about having made the incorrect decision or being put under financial stress, because let's
not create stress. Let's remove it. That's the objective.
Yeah, exactly that. Exactly that. All right, well, we'll wrap up there because we've hit our 45 minutes, I think, plus some. Thank you so much for everyone who attended. If anyone either live or on the replay wants to book an appointment, all you need to do is just head to our website, voyagefinancial.com.au. You should all know it by now because you're all our clients. Book in with either possibly myself or with David or Louise. We can start guiding you through the process that I outlined earlier before. We can start putting in place a team which will include the guys from Property Investors, Jason and Tony, who's sort of in our guy in WA. He's been helping a couple of our clients already, and we'll see if we can put you on a path to the 3 things that you mentioned, Jason, which is maximizing capital growth, maximizing cash flow, and
minimizing risk.
Third, that's exactly it.
Minimizing the risk. Yep.
Absolutely. All right. Thank you, everyone, for joining. Enjoy your Wednesday afternoon, and I will hopefully be talking to you soon.
Thanks, guys. Thank you very much.
Thanks. Bye.